Good morning and welcome to the Heritage Foundation in our Lewis Lehrman Auditorium. We, of course, welcome those who join us on this occasion on our heritage.org website. I would ask everyone here in-house as we prepare to begin to make that last courtesy check to see that cell phones are turned off. It's always appreciated. We will, of course, post the program on the Heritage homepage for everyone's future reference. And our internet viewers are welcome to send questions or comments at any time, simply emailing us at speaker@heritage.org. Hosting our discussion today is David Burton, Senior Fellow for Economic Policy in our Institute for Economic Freedom and Opportunity. He focuses on tax matters, security law, entitlements, regulatory and administrative law issues. Prior to joining Heritage, he served as General Counsel at the National Small Business Association. He was also Chief Financial Officer and General Counsel for the Alliance for Retirement Security, as well as a partner in the Argus Group. In the areas of finance and tax, he has held posts as Vice President for Finance and General Counsel at the New England Machinery, as well as Manager of the U.S. Chamber of Commerce's Tax Policy Center. Please join me in welcoming David Burton. David?
Good morning. Our subject today is how to make the tax policy process making process better. With the advent of the new Congress, I think we have a genuine opportunity to do so, probably the best in 2 or 3 decades. The subject may usefully be divided into 4 parts: revenue estimating, distributional analysis, tax expenditure analysis, and transparency. The first and most important of these is revenue estimates, or tax scoring, if you will. How to make revenue estimating more accurate. The core of the problem is to make revenue estimating reflect economic reality. And the economic reality is that taxes affect economic behavior, sometimes a great deal. The optimal tax literature, the public finance literature, the economic growth literature, and price theory are all very clear. Marginal tax rates and the tax treatment of investment have large macroeconomic effects. High marginal tax rates and tax policies that increase the cost of capital harm economic growth. Reducing high marginal tax rates and reducing the cost of capital promote economic growth. Historical examples in the United States and abroad abound. Yet the Joint Committee on Taxation revenue estimating methodology ignores these macroeconomic effects on work, savings, investment, and output. Now, why does this seemingly technical argument matter? Proponents of existing tax policy and those who support even higher tax rates and even more punitive taxation of investment understand that the current methodology makes tax increases seem as if they will raise more revenue than they actually will. Similarly, current methodology makes tax rate reductions or improvements in the tax treatment of business investment seem as if they will reduce tax revenues more than they actually will. Current methodology makes tax reform more difficult. It also does not distinguish between tax reductions that improve economic growth, such as reducing marginal tax rates or improving the treatment of business investment, and those that have little positive impact, such as child credits. Similarly, not all tax increases or tax base broadening are created equal. Broadening the tax base by eliminating unwanted subsidies is one thing, while base broadening or tax increases that raise the cost of capital or discourage work, savings, and investment have a substantial negative economic effect. The bottom line is this: calling for federal revenue estimates to take reality into account is not a gimmick or a trick or cooking the books. It's akin to acknowledging that the earth is a sphere and not flat. We should have done so long ago. Tax distributional analysis matters to policymakers, yet the analysis presented to them by the JCT and others are technically accurate but highly misleading in the sense that they too do not reflect economic reality. They too make constructive tax reform more difficult by misrepresenting its effects. First, tax changes are not zero-sum. If the economy grows as a result of a tax policy change, most people will be better off. Second, we should not look at just 1-year effects, but at least 10 years and preferably lifetime effects. Third, we should look at the impact on both income and consumption. The differences between these different approaches and the static one-year income approach presented by the JCT can be quite remarkable. The current highly idiosyncratic definition of tax expenditures written into the 74 Budget Act by Harvard Law professor Stanley Surrey is inconsistent with any economic theory of what is income. It's inconsistent with the Haig-Simons comprehensive income definition and with the Fisher-Touré conception of income, which views income as gross revenue less outlays made to earn future income. Under either definition of income, personal and dependent exemptions, standard deductions, graduated rate abatements should be tax expenditures. And under either theory, the double taxation of corporate income would be an inappropriate double tax or a negative tax expenditure. It's time that the legal definition was changed to reflect not a set of economically irrational prejudices about what a normal tax system is, but rather sound economics. The methodology underlying important revenue estimates and important distributional analysis should be disclosed to the public. The consequent discussion, analysis, and critique will make them better. The CBO is way ahead of JCT in this respect, although it too could improve. JCT revenue estimating methodology is nearly as closely held as NSA communications intercepts. It is time for the tax policy making process to be transparent. For those who are interested in reading more about this subject, the Heritage Foundation published this book, The Secret Chamber of the Public Square: What Can Be Done to Make Tax Analysis and Revenue Estimation More Transparent. It's available on Amazon, and I can give copies to those who are here that are interested. But it was published in 2005. Unfortunately, not as much has changed since then, although I think there's a real chance that that will change in the next Congress. Now, let me introduce our two excellent speakers who have a deep knowledge of this subject matter. Each of our speakers will speak for 15 or 20 minutes, and then we'll have audience questions. Douglas Holtz-Eakin is president of the American Action Forum. From 2003 to 2005, Dr. Holtz-Eakin was the director of the Congressional Budget Office, and during that tenure, he assisted Congress to address numerous policy issues, including the 2003 tax cuts, the Medicare prescription drug bill, and Social Security reform. From 2007 to 2008, he was director of domestic and economic policy for John McCain during the presidential campaign. And from 2001 to 2002, he was the chief economist of the President's Council of Economic Advisors. He's held a number of positions around Washington with think tanks, including being a senior fellow at the Peterson Institute for International Economics, at the Morris Greenberg Center for Geoeconomic Studies, and the Paul Volcker Chair in International Economics at the Council of Foreign Relations. He's also been a visiting fellow at the American Enterprise Institute, here at the Heritage Foundation, and the American Family Business Foundation. He began his career at Columbia University in 1985 and moved to Syracuse University from 1990 to 2001. He serves on the boards of the Tax Foundation, the National Economists Club, and the Research Advisory Board of the CED. He has a BA from Denison University and a PhD from Princeton. And without a doubt, he's one of the most informed and accomplished policy analysts in the country. He brings both academic and real-world Washington experience to our subject that is second to none. Scott Hodge is the president of the Tax Foundation, located in Washington, D.C. During his tenure, the Tax Foundation has more than doubled in size and become one of the most influential organizations on tax policy in Washington. He was a creative force behind the highly regarded modeling effort at the Tax Foundation and also the State Business Tax Climate Index, two programs that are changing the terms of the tax debate in the United States. He's written and edited 3 books on the federal budget and streamlining the government, and he's authored over 100 studies on tax policy and government spending. He's written widely, including for the Wall Street Journal, the Washington Post, USA Today, and previously served with Citizens for Sound Economy here at the Heritage Foundation and elsewhere. He holds a degree in political science from the University of Illinois at Chicago. Please join me in welcoming Doug Holtz-Eakin.
So Scott and I have conspired to remain in our chairs for this. He's going to run this. I have no fancy PowerPoints. I have done PowerPoint once in my life. I did it in front of the President of the United States, and I made a mistake, and he threw me out of the West Wing, and I gave it up. So I'm just going to talk a little bit about the issues that face us today, and I want to thank David and the Heritage Foundation for the opportunity to be here. These are obviously very important issues. Let me start and focus on this issue of dynamic scoring, which has been around seemingly forever. That was a very big issue when I first showed up at the White House in 1989. It was an issue again when I became the director of the Congressional Budget Office in 2003, and here we are again heading into 2015 with the same issues being litigated and relitigated. To me, this is a subject that should be a lot less exciting than it seemingly is to people on all sides. First, this is an issue of how to do scoring, and I'd like to explain to people that when I went to CBO, I entered a cult, and that's the scoring cult, and it is important to recognize what scoring is and is not. First and foremost, it is not forecasting. It is not trying to project the value of something in the future. If it were forecasting, we wouldn't have the same scoring baseline, which is set in March of each year, throughout the entire year. No forecaster would leave that fixed. They would update as you went along so that you'd have an accurate starting point, and then you'd analyze the proposals. And what fixing it tells you is that you're trying to get some consistency in the scoring process, and that raises what is really the top priority in any scoring exercise, and that is to order proposals correctly. You want to know which spending proposals are going to cost the taxpayer more and less. You want to know which tax proposals are going to raise more and less revenue. You want to be able to order them in a consistent fashion using the same starting point and the same methods for analyzing the changes so that you give the policymakers the information they need to make good decisions. And so the desire to get the scoring process right is really answering the question, how can we deliver the best information to policymakers and in the process consistently order proposals so that they can make good decisions? So the only difference then between static and dynamic scoring is the issue of economic growth. Static scoring, despite its name, includes all potential economic responses to tax or spending proposals. Do people save more, save less? Do they readjust their portfolios? Do they work more, work less? But in the process, you keep fixed the total size of the economy, the pie, and all that any economic response can do is redistribute that total GDP in some way. Dynamic scoring allows the possibility that the economy will either grow or contract as a result of the policy. And that's an important thing to know, because if you have, and this isn't a hypothetical because I've stared at the slides, two proposals that are identically scored on a static basis, one of them, when looked at in a dynamic way, causes the economy to grow, the other causes the economy to shrink, you will convey in a dynamic score the fact that this one has a bigger economy and this one has a smaller economy to the policymakers. That's information they should know, because in the end, good policy is not about the budget. Good policy is about the people living in the United States, and it may be reflected in the budget, but if you've got information about those policies and the well-being that they're going to deliver into the United States, that's something that the system should deliver on a regular basis. And I believe that's the simple and straightforward case for bringing into the revenue estimating process and the spending process some notion of dynamic scoring so that we get an idea of what's going on. That's the key. And then there are all these sort of frequently asked questions about dynamic scoring that it's just worth thinking about and thinking about outside of all the emotion that seems to be attached to this. First, is this going to somehow damage the process? Is it cooking the books? Is it somehow an anathema to good budgeting? And the answer is no. Right? The whole point is to deliver information. It's an improvement in the process. The only thing that needs to be, in my view, sorted out is when will you do a dynamic score and how is it going to get done? And those are things that the Congress needs to tell the Joint Committee and the CBO, because it shouldn't be up to the staffs to have to make this decision, because then the act of making the decision will be perceived as somehow signaling something about the proposals. I'm not going to dynamically score that one. I am going to dynamically score this one. The staff should absolutely not be put in that position. All we need is, in the next Congress, some simple rules. Anything that's going to have large macroeconomic significance, we're going to dynamically score. Here's how we identify it. And then you, the Joint Committee, or you, the CBO, go off and do the analysis of the proposal and give us the answer back. Second question that always comes up: won't this just introduce a whole lot more uncertainty into the process? Like, we just don't know enough to dynamically score. I think this basically makes the mistake of thinking that static scoring is somehow very precise. Introducing dynamic scoring is going to lose that precision, and we shouldn't trust these numbers very much. The reality is scoring is just really hard, and there are many things in static scoring that have an enormous amount of uncertainty around them. The examples that I always point to are that when I was at CBO, we scored the first Terrorism Risk Insurance Act. The federal financial consequences of an unknown terrorist act in an unknown location using an unknown chemical or nuclear or biological weapon, and what's that going to cost the taxpayer, and in what years? And that's hopeless. I mean, it's enormous range of uncertainty, and you try to get it in the ballpark and move on. We were also asked to take a look at a bill that would have paid a $100,000 bonus to the family of any serviceman or woman who died in Iraq prior to the invasion of Iraq. A little uncertainty around that one. And the lesson here is that inherently there's going to be some uncertainty, and you just have to live with that in the process. You do your best to put the point estimate in the middle of the range, and just be just as likely to be too high as too low. And I don't think there's anything about dynamic scoring that inherently changes that calculus. The next thing is, should you only do dynamic scoring of tax proposals? Absolutely not. You should do dynamic scoring of spending proposals too. And the information about when spending genuinely improves growth is something policymakers should know. The information policymakers need to know about when spending damages growth, I think, is comparably important. When I was at CBO in 2003, we did the first of the macroeconomic analyses of the president's budget, essentially a dynamic score of the president's budget. That budget contained two important policy initiatives. One were the 2003 tax cuts, lower rates, better tax treatment of capital income, things that I thought then and continue to believe were good tax policy and highly beneficial for the growth outlook. It also contained the Medicare prescription drug bill, which spent $400 billion on seniors' bills for outpatient prescription drugs. Might be a good idea, but it's not exactly pro-growth. The idea of subsidizing more consumption is really at odds with growth policy. When we did the analysis, what we got was modest beneficial positive effects on net. I thought the Congress would conclude that, maybe it's not a good idea to offset this beneficial growth tax policy with this big spending program. That's not the conclusion they drew. The conclusion they drew is that we did it wrong. And but I think that there's a real lesson there that you should do both sides and have them realize that you can't just somehow think that growth happens over here. You do that and it's done, and you can do whatever you want over here and it'll be fine. You have to always be looking at a disciplined fashion on all sides of the budgetary picture. The other thing that comes up, and you see this now in a lot of the commentary that's going on, is that somehow this would be damaging to the institutions of the Congressional Budget Office or the Joint Committee on Taxation. I don't think that really makes any sense. The Joint Committee has been doing dynamic scoring for a long time. There were House rules that required dynamic scores in certain circumstances. They were supplementary. They weren't the main score, but they did it. They just did a dynamic score of David Camp's tax proposals. The CBO has done a dynamic score of the president's budget every year since 2003. It recently put dynamic analysis into the analysis of a Senate immigration bill. There's nothing about this that the staffs aren't capable of doing, that they haven't done already, and the only question is sort of how to make it better. And then the last thing I'd say is about this difficult issue of how you think about the transparency in the process, whether it's at CBO or the Joint Committee. Transparency is an important issue in public policy, but transparency is, in this setting, can't be the same as scientific replicability. There are instances when the CBO in my tenure and others, had access to highly proprietary information from, in my case, the drug companies, for example, when we did the prescription drug bill, that we signed confidentiality agreements. We promised never to turn that over to anyone, including the Congress. I would have laid down my job before anyone saw any of that. It was crucial to the scoring process, but there was no way that anyone could do a replication of our analysis from the outside. There isn't. So that shouldn't be the standard. That's just not the right way to think about it. There should be, in the analysis, some sort of description of the important issues and how the score took them into consideration. And there should be some transparent disclosure of what they think is important and not important. But it's important to recognize that in the end, scoring is a judgment business. You think of the examples I gave you, there will be judgments involved. And I think it would be highly undesirable to so totally expose the staffs to write down every single thing that they ever did or thought about in what is ultimately a judgment business. We should hire good staff, respect their judgments, put into the process all the growth and other considerations, and have the process reflect that information. But there will always be an element of judgment in this, and I think it's important to recognize that in this debate. And that's something that should be, if you have a process that ultimately is going to require judgment, respect the judgments that are made by people and reward people for having the willingness to make those judgments. On these other issues, let me just say, I think there's some important work to be done, particularly in the tax expenditure world, where depending on what you view as the appropriate tax code, you get a very different list of tax expenditures. I mean, if you believe that the appropriate base for a tax code is consumption, as I do, you don't think of reduced taxation of the returns to capital income as a tax expenditure. That's just the best tax treatment. If you think it's Haig-Simon's income, you come to a very different conclusion. And so while I don't think this will be resolved easily, I think the notion that somehow, we wrote down in 1974 the right list of tax expenditures and we should somehow legislatively lock that in is a real mistake. This is an area that needs a lot more debate. And one of the things that I think would be very useful to think about is the whole issue of how we treat refundable tax credits and how we think about the distribution of taxes in the process. The current treatment of, say, the earned income tax credit is that if you have a tax liability of $100 and you have an EITC of $150, the first $100 eliminates your tax liability. It's viewed as a reduction in taxes. The last $50, which gets sent back to there, is an outlay of $50. I don't think that's the right way to think about this. When we put in place an earned income tax credit, we don't know what a person's tax liability is going to be. We make a commitment that we will return those credits to them. They're refundable. And I think we should budget the entire 150 expected EITC as an outlay, with the notion that it's quite possible that they wouldn't have had the liability the way we thought. And if you did that, you'd get a very different federal budget. You'd get more taxes collected and more spending, which I think is an accurate reflection of what's going on economically. And the distributional tables would also reflect that many lower income people are paying taxes that are disguised right now by the outlay. We could have just turned the EITC into a spending program from the beginning, and we'd see a lot of taxes collected at the low end and a lot of spending to offset it. So in terms of getting these distributional tables right, even the way they're done now, I think the budget committees and the Congress ought to really think about some of these issues and fix some things that have been put in place from a long time ago. So I'll close there, and I just want to say I think this is a really important issue. My experience with the dynamic scoring with some of these distributional issues is that they're never as dramatic. If we fix it and get it right, it's never going to be as dramatic as people might hope. That isn't a reason not to do it. We should do it. But many of the people on the Hill in particular like to point to the process as the problem, but the most famous saying in the history of CBO is Rudy Penner's, the process is not the problem is the problem, and we need to get better tax and spending policies. That's the problem.
Great. Well, thank you, Doug, and thanks, David and Heritage. I spent 10 years in this building, so I have quite a few fond memories of, actually appearing on this dais once upon a time. I want to kind of address some issues that I've been hearing in the media recently. You hear a lot of folks, especially on the left, very critical of dynamic scoring, and I think to some degree, some of that has been driven by those who have advocated dynamic scoring in the past have really oversold it. And in fact, I heard yesterday Congressman Chris Van Hollen, who's a Democrat and on ranking member of the Budget Committee, and said, this is really, I think this is what his message was, that dynamic scoring is a smokescreen for cutting taxes and not paying for them. And that's really, it's wrong, but I understand his perception because of how so many people, advocates of it in the past, have really oversold it. And what dynamic scoring really is, to me, is a way of increasing the tax IQ of members of Congress so that they pursue policies that increase economic growth, and they avoid policies that will retard economic growth. And so this is just another way of raising or giving them more information that they can use to make better decisions. And it's not trying to impose an ideology on these nonpartisan academics or analysts at CBO or Joint Tax. This is just a way of, I think, increasing the information that members have so they can make better decisions. Let me start out with a little test, just for fun. Which administration said the following, and I'll quote, "We confidently expect that the lower rate structure we propose will soon yield more revenues from an enlarged economy than would otherwise be the case if we continue with our present repressive tax structure. In other words, paradoxical as it may seem, the desired goal of a balanced budget can be reached more rapidly with tax reduction and reform than with our present tax system." Was that the George W. Bush administration, the Reagan administration, or the Kennedy administration? Kennedy. Very good. I knew I couldn't fool you guys. In fact, in his address to Congress where he presented his tax plan, Kennedy said, quote, "Within a few years of the enactment of this program, federal revenues will be larger than if present tax rates continue to prevail. Furthermore," he said, "total output and economic growth will be stepped up by an amount several times as great as the tax cut itself." In fact, the Kennedy administration actually did dynamic analysis. They in their projections of their deficit, they talk about how the effect of their tax plan on the deficit will be smaller than otherwise thought of because of the, quote, feedback effects, and he used those terms, that would result from the economic stimulus. So this is hardly a new notion. It's hardly a notion that was invented by Arthur Laffer or Ronald Reagan or other supply-siders. This goes back a lot. This is really good economics. It's not voodoo economics. What I want to do is take away some of the mystery of dynamic scoring, pull back the curtain, so to speak, because there is so much mystery behind it. And I want to talk about the Tax Foundation's model in particular because it's what we know best, and really kind of reveal some of the guts of it. What I had wanted to do was some actual simulations, live simulations, but it's hard to do on a screen like this for people in the audience. So what I'll do is just talk about the basics of the model, so you have a real understanding. You come away with some rules of thumb, so that you can understand how different tax policies affect the economy differently. This is kind of hopefully the last of the jargon that I'll use, but our model is what's called a neoclassical growth model. And what does that mean? Well, under the neoclassical concepts, the big drivers of the economy are the cost of labor and the cost of capital. And so what our model does is try to measure or calculate the effects of tax policies on the cost of labor and the cost of capital. And a good rule of thumb to know is that a lot of economic empirical evidence has shown that capital is far more responsive to tax changes than is labor. And why is that? Well, because capital can move very quickly across time zones and countries and so forth, but it's very hard for me to pick up my family and move to Ireland because my boss has moved our factory there to take advantage of their lower tax rates. So keep that in mind as we go through, that capital is far more responsive to tax changes than labor, and you'll see that through a lot of our slides. And so you think about it like this. First, what we do is we measure these effects on the cost of capital and the cost of labor. We then simulate those effects on the economy, and from there we can estimate the effects on GDP, on capital stocks, the wage rates, hours worked, excuse me, federal revenues, of course. That's one of the most important things that members of Congress want to know, both in a static way and in a dynamic way, so you can see the differences of the two. And then we can look at the distributional effects of these changes as well, in a static way and a dynamic way, so you can see the effects of those economic changes. And there are really two components to our model, or any of these models really. There's a tax simulator, an individual income tax simulator, and then there's the macroeconomic side of the model, which estimates the effects on the economy. The inputs you can think of the tax simulator as sort of a giant TurboTax, or a souped-up TurboTax that computes the tax changes for the entire population of individual income tax payers. And we draw from a database that the IRS makes available. It's called the Public Use File. It has 150,000 representative tax returns in it. And we have actually, interestingly enough, we have these files going back to 1965. So we have a large history of these taxpayers, if you will, which we can use actually to look back in time and measure the tax effects of different tax changes in history too. And then we project out this data through 2025 so that we can project forward through the budget window the effects of tax changes. And on the macroeconomic side, it's very robust. This is our the neoclassical side, if you will, and this is what computes the tax changes or the changes to the returns to capital and the supply of labor. And this is where we make any changes to the corporate sector. And this draws from a huge amount of data. We have tax parameters going back to the 1950s, national income and product account data going back to the 1950s, depreciation schedules going back to the Eisenhower administration. Man, you want to talk about exciting to look through that table. My friend Steve Etten here, he loves that table. And then we project out this data going through 2025 as well, so that we can look at these long-term effects of tax changes. These two sides of the model work interactively, so the tax simulator, for instance, computes those changes to individual marginal tax rates, and that feeds into the macroeconomic side, which also, if we make any changes to the corporate side, that produces new growth factors in incomes and wages and business income and so forth. That affects the wages within the tax simulator, and the whole process goes round and round iteratively until you reach a new equilibrium or a new state of the economy. That's your dynamic state. All of that happens actually in about 15 seconds, far less than it takes me to actually explain it. So the model works very, very quickly. Now let's sort of look at the effects of this, because I think we all intuitively understand that different changes changes in tax policy affect the economy differently. And we shouldn't treat it as though it's all the same. And so what we did is took 5 different tax cuts, all with about the same relative static value, and we ran it through the model to see how it affected the economy differently. And so what we have here is a $1,000 child tax credit. We have 2 changes to personal income tax rates and 2 changes to the corporate tax. One is a rate cut, and the other one is moving to full expensing. And as you can see from this slide, they produce wildly different results. The child credit has virtually no impact on economic growth. It does have a little bit, but we just rounded it to 0. Because the reason is that it really doesn't have effect on marginal tax rates. It's more of a social program through the tax code, and it doesn't really encourage people to work, or the price of labor as economists talk about it, so it's going to have very little impact on the economy. Meanwhile, if you change individual tax rates, you're going to get a little bit more effect on the economy. In this case, as much as 0.65% increase in GDP after the adjustment period, which can last anywhere from 5 to 10 years. But you can see a much bigger impact on GDP from cutting the corporate tax rate by 10 percentage points. You can see a more than 2% increase in GDP. But if you move to full expensing, which dramatically lowers the cost of capital, it has a far bigger effect on the economy, as much as a 5% increase in GDP after the adjustment period. And why? Because it so dramatically lowers the cost of capital. And these have big effects on, of course, federal revenues as well. And so what this slide does is it shows you that in the blue, these are the static revenue estimates of these tax changes, all about $71 billion, but they have very different dynamic effects. The child credit actually costs on a dynamic basis as much as it does on a static. Why? Because it has no impact on the economy. Whereas at the individual tax rate changes, get back about a third, or 25% to a third of their static revenue because of the economic effects. The corporate tax change actually pays for itself over time because it generates about $370 billion worth of new GDP, and that leads to more revenues. The move to full expensing, even more dramatic. It actually raises about $106 billion in new revenues because of the tremendous amount of economic growth. Now let's look at the flip side of this, because there are times where members of Congress want to raise taxes. And they ought to know which taxes are going to cause the least amount of hissing from the goose as they're plucking it. And dynamic scoring doesn't show you any effects on the hissing on the goose, static scoring doesn't, but dynamic scoring at least tells you how much hissing there's going to be. And here we have 5 different tax increases. One is moving from our current depreciation schedule called MAKERS to an alternative depreciation schedule, which are longer depreciation lives. We have a corporate tax rate increase. We have 2 increases in personal income taxes. And then the fifth one that we measured was disallowing a portion of the state and local tax deduction. And as you can see from this bar chart, they have dramatically different effects on the economy. Lengthening depreciation lives knocks about 2 percentage points off, or 2% off of GDP over time. Increasing the corporate tax rate lowers GDP, the level of GDP by about 1%. Whereas raising top marginal tax rates or even bottom marginal tax rates has a less effect on GDP, but still some. And then, of course, disallowing the state and local tax deduction has the lowest. These, of course, have effects on federal revenues as well. As you can see from the blue bar here, each of these plans had a static cost of around $32 billion, but very different revenue costs on a dynamic basis. And obviously, the biggest effect is moving from MAKERS to ADS. As you can see, it lowers GDP by about $300 billion, which actually ends up lowering tax revenues as a result. So the true cost of this policy is quite substantial, not only in terms of lower GDP, but lower revenues. And we see similar results by raising the corporate tax rate. You get a little bit more revenues, actual revenues, from raising top personal income tax rates or even the lower ones, but not as much as were expected on a static basis. And that's because of the revenue or the GDP lost. And so the true cost of those policies is the combination of the lost GDP, about $54 billion, and the amount of new revenue that's raised, about $20 billion. So it's the real cost to the economy or the private sector is $70 billion. The policy with the least effect on GDP is disallowing the state and local tax deduction, and that comes a little bit closer to raising as much on a dynamic basis as it does on a static basis. So now that we've understood all these individual parts and how they work and why the influences of tax changes have on them, we can look at some macro policies or big, tax reform proposals and compare them. And so what we've done is taken an X-tax type plan. This is a plan that Doug and his colleagues kind of put together, and it's a variant of the flat tax or a cash flow tax. It has a progressive rate structure for individuals. For both individuals, the top rate is 35% and the same as the corporate rate at 35%. Individuals get a large sort of standard deduction or personal exemption, and businesses get full expensing. And we've matched that up against a stylized progressive plan. This is like a Thomas Piketty type plan that raises the top rate to 50% and taxes capital gains and dividends at ordinary rates, otherwise 50%. Dramatically different economic results, as you can see here. The X-tax plan, or this consumption-based plan, boosts GDP by 13%, which in turn boosts capital stock or business stocks by 42%, which in turn boosts wages by 11%. The flip side is then the case with the progressive plan. It lowers GDP by 10%, lowers the capital stock by 27%, and ultimately lowers wages by 9%. The effect on federal tax revenues is equally opposite here. As you can see, the X-Tax plan boosts federal revenues by $2 trillion. This is at the end point, by the way. This is an annual basis increase in GDP of $2 trillion, which raises federal revenues by $400 billion. And the progressive plan knocks about $1.7 trillion off the level of GDP at the end of the policy, and then lowers revenues at the same way. Now, last, I want to address the distributional tables, because oftentimes we're given these very static distributional tables, and in particular, and things like corporate tax rate changes, you don't see any effect on individuals on a static basis because they assume, well, that corporate changes don't affect individuals. But they do, because as we've seen from the economic effects, it can increase wages and incomes, and we ought to be able to see that on our distributional tables. And that's what this table shows you here, that after the macroeconomic effects are taken into account of lowering the corporate tax rate, boosts incomes by almost 3%, and you can see that across the board in virtually every income level that there is. Let me just close by saying that, look, dynamic scoring is not only possible, it's being done by both the Congressional Budget Office and the Joint Committee on Taxation. The only question is when it's going to become more official and used as a real tool to inform members on a consistent basis. And I kind of liken this to the move from Major League Baseball to instant replay. And Major League Baseball was the last of the major sports leagues to go to instant replay because they realized it was so patently obvious that umpires didn't have enough information to make the right call. And in a similar way, dynamic scoring is about giving members of Congress the information they need to get the call right. And I tell you what, the future of this economy is far more important than a baseball game. And so it's really important that members of Congress get the call right, and they need this kind of tool to help them do that. So thank you very much for the opportunity. We'll open up for
Doug, you want to
questions.
say something?
Yeah, I just want to steal this slide, right? I mean, so this, what I think has been a mistake has been too much attention paid on the heights of the bars and how much things go up and down. These are two plans that on a static basis are identical. And so in ordering which tax policy we should pick, they're a tie.
Yeah.
And if you put this into the process, forget the size of the bar. You get them in the right order. One goes up, one goes down, and that's what has to be put in, and that's what's been left out for too long.
Thanks for reminding me. I should have pointed that out. That's great.
I wasn't editing your
At
remarks.
least you get the sign right.
We're listening. That's good.
Questions? And would you please wait for the mic so that the people on the internet can hear it? And also, if you could, state your name and affiliation.
Yeah, Jim Brady with Deloitte. So what would be the percentage of professional economists and tax experts that would say, hey, dynamic is right and static? What's the percentage? And then the next question is of
Do
the
you want the
535.
static estimate or the dynamic?
Yeah, I mean, who would say is the right answer? What is it? 2/3, 1/3, 2/3 of economists say dynamic, and then of the 535 on the Hill, what's the percentage that believe in one versus the other?
I truthfully don't know. I mean, I'm a trained economist, and when you analyze policies, you look at, what it is now, what it would look like after the policy was instituted, and you look at all the changes. You don't say
But
these
in
changes are in and these
you know,
changes are out.
You would have some proportionality. I mean, is it overwhelming people believe in one or the other, or is it 50-50? I just want to get a sense. of
People's
the
style, as a matter of qualitative, is that the right way to do it? The answer is typically, very close to unanimity. Their issues are practical ones about, can you do it? And I always thought the point of doing it in 2003 and doing it every year is to simply make the practicality sort of easier and easier to do it, both at the production end. Like, you have to do these estimates, and they don't happen overnight, and you have to make judgments about things, and you have to learn about some evidence on the judgments you have to make. But also, the Congress needs to know how to interpret them. They need to be comfortable with what they're getting and learn. And so the whole idea of doing it again and again is to both sides get the education necessary. And so I would hope the objections have diminished on those grounds.
Yeah, and
Have they diminished?
well, I think that economists are getting closer and closer on these issues. You often hear, and especially from members of Congress, that, well, economists aren't agreed on all these technical issues like labor elasticities and all of these things. And, to some degree that is true, but I think if you look at all of the groups or people doing dynamic analysis, they are getting closer and closer in their results. A good example of that is the dynamic analysis that was done in the Camp draft. And actually, the Joint Committee on Taxation produced a range of about 8 different estimates. They used 2 different models to do it, and the range was, somewhat considerable. It's from about 0.1% additional growth all the way to 1.6% economic growth. And the Tax Foundation's dynamic analysis of the Camp plan was at the lower end of that range, whereas an analysis that was done by John Diamond at Rice University, using a different model, similar to the one that Joint Committee used, was closer to the higher end of that range. However, we ran our model using some of the assumptions that Diamond used and came a little bit closer to where he was. He similarly ran his model using some of the assumptions that we made, and he came closer to where we are. So once you kind of get, you start narrowing the band, we're not all that far away. And members of Congress should have a lot more confidence in these kind of results. If nothing else, the signs of everyone's results are pointing in the same direction. Right now, static scoring or conventional scoring points in one direction, and that's this way. But at least the people who are doing dynamic scoring are all pointing in the right direction or the same direction.
So I literally, without making too much of a pun about this, the dynamics of this are actually very important, because CBO, for example, the way we made judgments on all these tough calls, like in modeling health insurance and big healthcare reforms or Social Security reforms, things like that, the rule of thumb is you use the consensus in the literature, right? So you try to identify not what you really think is the truth, but what's the literature told us about this. Often there's not much literature, and that makes it harder. And if you start doing this, so for example, you start doing the dynamic scoring of big proposals, there's a big industry out there that wants to second guess the CBO and the Joint Committee and wants to understand how the world works and wants to analyze the policies. That's all a good thing. They'll start doing studies. You can start looking at what they find, and you'll narrow the difference between, Tax Foundation and John Diamond, because the literature will get richer, and we'll find out what really is the best estimate of some of these responses. So, I think those are all reasons why this should not be feared. I mean, this is how you learn. You go do it and get the information into the process.
John?
I think I know where I'm going to get eventually, so excuse me, but most congressmen are not driven by anything other than constituents and votes and numbers. This is a very inside the beltway game. Economics and tax policy is a foreign language to their constituents. It's not a sexy issue, and it's very hard for them to explain to someone, so they just avoid it. And are we not, while capital is key, trapped into this game of, but capital increased the money for the capitalists. It's not increasing it for the general public. And so much of our tax policy in the last 20 years is really driven on class warfare and tweaking and playing little nuances here and there, rewarding this one and that one. Do you see a way to get around that very major roadblock to me in the middle of everything, because it's this class warfare aspect of how we've been using the taxes in the last year. We're not looking at taxes as simply how do we raise revenue, and when we raise revenue, do we spend money based upon realistic spending?
So
No small problem.
Yeah, so just a couple of thoughts on that, which don't constitute a solution of any type. Number one, constituents are what matter. And we have had a recovery in which the median family income's fallen. Constituents care about that. And so that there's a case to be made always for things that improve their lives. And that's the route down which everyone should go. Second thing is, good economic growth policy is not the only policy objective. There are legitimate distributional goals, there are legitimate environmental goals, there are legitimate social goals, but the key is to always be cognizant of the trade-offs. So if you want to have a class warfare redistributional tax policy, and that's what you want, you should know the cost of that. And all this does is make that clear, and that's probably why many people fear this, right? I mean, I understand that. But the flip side of that is, if you really want to have good growth policy, at every point in the policy process, when a trade-off has to be made, you have to understand what are the growth consequences, what can you get or give up, and that's what's missing right now, is a regular level playing field consideration of the multiple policy objectives. We got the distributional objectives, we've got the social objectives, but there's no place where this enters on a regular basis. And it is very inside baseball, and it's the geekiest subject to ever, I think, end up on the pages of the New York Times with such regularity. But it's really about how do you get better economic growth in the United States.
Yeah, I'll echo a lot of those sentiments. I heard Senator Rob Portman yesterday, who is a true expert on this, talk about dynamic scoring. And it was very common sense. He said, look, if McDonald's raised the price of a Big Mac to $10, they'd sell less of them. If they lower the price, they probably sell more. That's really at the heart of this. It all comes down to real economics, and people see it in their daily lives. But more importantly here, one would think actually that folks on the left who are so concerned right now about middle class wages and how that's been so flat for more than a decade would actually embrace this sort of analysis, because it helps us understand what are the policies that are going to have the most effect on middle class wages. And a lot of it has to do with lowering the cost of capital so that we can put better tools in the hands of middle class workers so that they can earn more. And so I think we need to do a better job to reach out to people in the unions and elsewhere so that they can understand what we're trying to do here is not enrich, capitalists and so forth. We're trying to enrich the middle class through policies that actually increase economic growth and increase the capital stock and make us a wealthier nation overall. But it's a tough learning curve, and it's hard to get past it because so much of it is caught up in ideology.
This gentleman.
Nick Farmer, private citizen. Have you run your model retrospectively, that is, going back and look at actual tax law changes that have occurred and see what your model would have predicted had it been used?
Yes, actually, and my colleagues here, Steve Enton, who worked previously with a group called IRET, IRET.org, by the way. If you go on their website, you can see a number of studies that Steve and his colleagues did looking at all the major tax bills from Kennedy forward. And it's really quite enlightening because it does give you, much like these slides, a great insight into the types of tax policies that help create growth and those that actually retard growth. And the Kennedy tax cut was actually one of the most pro-growth of all of those different tax policies.
Steve.
Steve can talk about his own studies now.
Steve Hinton, Tax Foundation. Kennedy was actually wrong. He didn't quite pay for himself, but he came awfully close. He did pay for himself just about on the business side, but not quite on the individual side. But he got a lot more reflow than alternative types of tax cuts would have gotten. I think that's very important. I nearly interrupted you, Doug, when you were speaking to applaud something. You were saying I didn't want to cut your flow off.
Would have been the first time. Thank you.
But your point that it's not just about the budget process and making the numbers come together in the Congress, it's about the constituents and what their situation is going to be after the policy change. And I really appreciate your saying that. It really is something the members need to think more about. It's not about them, it's about their constituents. In these graphs, we show the change in GDP, the capital stock, and the wage. And a distribution table, as they're currently produced in the run-of-the-mill situations, doesn't show the change in your pre-tax income or your wage. It just shows the initial tax hit. And I wonder if it isn't important to amend the distribution tables to show the economic burden, not just the initial economic incidence, so that people can see that cutting the corporate tax rate helps the people working in the corporation. Can that be worked into the process in any way? Another question is you raised is about the tax expenditure tables. There was a time that, I guess it ended in 2009, but there were several years where OMB had different tax expenditure tables for the different tax bases. I think they had 3 bases. And joint tax, I don't think, has done that. Would it be useful to have that added information presented, and would it be all that much trouble to do?
I'm always in favor of more information. And I mean, the question is sort of regularizing it. So I liked the OMB presentation. I don't know, I don't know if the Joint Committee has done that or hasn't. I just don't know. So we could find that out.
I don't think so.
The thing with the distributional tables is just the same as doing the macro growth effects, right? I mean, you can present, there are different presentations you can do, economic incidents, the sort of who sends in the checks, a very static tax incidents, things that look before and after the growth effects. There's a lot of information. There are lots of different presentations. The questions so I think that should be done. And a lot of it is done as supplementary information. You see lots of people analyze something and say, oh, well, this is what I think the genuine economic burden will be as opposed to the table. The question is which presentations are useful to policymakers and how do you regularize their production so that people get them in real time for the policy decisions they have to make. And on the distributional side, it's behind the dynamic scoring side, quite frankly. I mean, that work would need to be done. But again, I don't see an obstacle. There's going to be an initial disagreement about what's the economic incidence of the corporation income tax, no question about it. You're going to have to work through what becomes the consensus in the literature. You're going to have to work through how to present it. It's not something that happens in 2 months, but there's no reason not to start that process.
Yeah, you hear a lot of members of Congress and others just sort of almost flippantly say, well, if we just broaden the tax base, get rid of all those loopholes, and we can lower rates, and then we'll have economic growth. And I said, well, okay, that sounds pretty good. Now, do you consider a 401k a loophole? Do you consider a lower capital gains rate a loophole? Do you consider shorter depreciation lives a loophole? And then you can start seeing the brow furrow, and they realize, oh my gosh, there's a lot of things that are considered loopholes just because they're on these tax expenditure tables. And when we actually looked through the most recent tax expenditure tables and kind of added up the ones that are either overcoming some of the biases in the code or actually, protecting savings and moving us toward a consumption base, it adds up to about 60% of the total of this $1.4 trillion worth of tax expenditures or loopholes. So the real base in which you're eliminating in order to reduce rates is a whole lot smaller than what people actually think.
It's the other thing I'd emphasize, with this slide up is what Scott said about just raising the tax IQ. We don't ever see anything that looks like the thing on the left nor the thing on the right because they're pure. I mean, one's pure redistribution, one's pure pro-growth, and those aren't the actual tax plans Congress ever produces, right? They produce things that have elements of both and that sort of knocks them closer to zero, and you end up with relatively modest effects. I think that's a lesson for people who fear this, who think we're cooking the books, is no Congress has ever been so disciplined as to produce something that looks like the X tax. At the same time, they've never been given an instruction manual to do it. They've never watched and said, well, if we toggle that, this one goes up and that one goes down, and then we can move this direction. All of that, I think, would be valuable for the Congress to know. And really, that's one of the benefits of building this into the process.
All right, any other questions? Well, thank you two gentlemen
you.
for a very
Thank you.
fine presentation.
Appreciate it.
Just-